Hey guys, welcome back to our channel where we talk about everything money. Today we're talking about credit scores. We know they can feel like a mystery. They're just three numbers, but they can make a huge difference when you retry and to do. I'm Sarah Bianan Armorman on Sinraman or when Ramar and Simmer no one renver sense sense and some sensei lace and sings and And the crazy thing is, there are so many misconceptions out there about how credit scores work. A lot of people do. I understand what goes into calculating their credit score, and that makes it harder for them to improve it. So today we're going to put some of those myths to rest. We've regone. I'm going to cover everything from how often you should check your score to whether you actually need a credit card. And we've regone show you how to get the answers you need in a fast and easy way. Because when it comes to credit scores, knowledge is power. Stay tuned until the end. If you're ready to crush those credit score myths, smash that thumbs up button and let's dive into it. Myth No. 1. Checking your credit score lowers it. Let's start with one of the most common misconceptions out there. Many people believe that checking your credit score will lower it, which couldn't be further from the truth. When you check your own credit score, it's called a soft inquiry, and it has no impact on your credit score at all. In fact, checking your own credit score is highly encouraged. Regular monitoring allows you to spot errors and track your progress, so you can quickly address any issues or concerns that arise. Soft inquiries are only visible to you and not to lenders. Only when a lender pulls your credit as part of a loan or a credit card application is it called a hard inquiry, and this may lower your score by a few points temporarily. But checking your score on apps like Credit Karma, Experian, or directly through your bank? Zero impact. In fact, it's encouraged. Myth No. 2. You only have one credit score. Now, here's a big one. You actually have plenty of credit scores. There's no single score that applies in every situation. Different lenders may use different versions when assessing your application. So if you see your score on one app and it's 7120, don't be surprised if a lender pulls a slightly different number. For instance, there are multiple FICO scores, TransUnion, Equifax, and Experian, and each bureau may generate a slightly different score. Plus, there are different scoring models within each bureau. FICO has its classic score and its 9 and 10 versions. Then there are Vantage S-scores 3, 4, and 5. These models use varying algorithms and look at different factors, leading to different results. Each credit reporting agency may generate a slightly different score as well, since they use slightly different data sets. Remember, even though you have multiple credit scores, they all generally fall within the same range and reflect similar levels of creditworthiness. 8. Let's move on to the next myth. Myth No. 3. You need to carry a balance on your credit card to build credit. Now, this is a major misconception. Carrying a balance does not help your credit score. In fact, it can hurt it. What helps is using your credit card regularly and paying it off in full and on time each month. That shows lenders you're responsible with credit. To build a good credit score, you want to keep your credit utilization low. Generally, lenders like to see it below 30% of your limit. So if your card has a $1,000 limit, aim to keep your balance under $300. A balance of $0 at the end of each billing cycle is ideal. Paying off the full balance shows you don't rely on credit to fund your lifestyle, and that you can handle your financial responsibilities. Myth No. 4. Closing a credit card will help your score. Some people believe that closing credit cards will boost their credit score. In fact, it can have the opposite effect. Closing a credit card, especially one with a high limit or long history, can reduce your overall available credit and potentially shorten your credit history. Both of these factors can lower your credit score. Instead of closing old cards, consider keeping them open with a small recurring charge like a streaming service subscription. Pay it off each month. This maintains your credit utilization and the age of your credit history. Just make sure you cancel before the renewal date to avoid paying the annual fee. Now let's tackle myth no. 5. Myth no. 5. Your income level affects your credit score. Now this is absolutely false. Your income level does not affect your credit score. Credit scores are calculated based on credit activities such as payment history, credit utilization, account age, and recent inquiries, not your salary. Lenders use your income to assess how much credit you can afford, not to determine your actual credit score. So someone with a modest income can have an excellent credit score and someone earning a high income can have a poor score. It all depends on how they manage their credit and debt. Moving along to myth number 6. Myth no. 6. Paying off a loan will immediately boost your score. While paying off debt is always a wise financial move, it doesn't instantly give your credit score a huge jump. In fact, paying off an installment loan, like a car loan or student loan, can temporarily lower your score because it reduces the mix of credit types on your report. However, the long-term effect is positive. Paying down debt improves your debt-to-income ratio and shows lenders that you fulfill your financial obligations. So while there may be a slight dip in your score initially, consistently making payments on time and reducing your debt levels will eventually boost your score over time. Let's bust some more myths. Moving on to myth no. 7. Myth no. 7. You need a credit card to build credit. Don't have to use a credit card to build credit. While credit cards are handy for establishing credit, they're not the only option. You can also build credit through other types of accounts, including student loans, auto loans, personal loans, or by becoming an authorized user on someone else's credit card. There are even credit builder loans and rent reporting services that can help you establish a credit history without a traditional credit card. So if you prefer not to use a credit card due to the risk of debt, you still have options to build a solid credit profile responsibly. Next up, myth no. 8. Myth no. 8. Paying off collections will remove them from your credit report. Once a debt goes to collections, it stays on your credit report for up to 7 years from the date of the original delinquency. Even after you pay it off, it's unfortunate but true. However, newer scoring models like FICO 9 and Vantage S-Score 4.0 don't penalize you as much for paid collections. Still, older models do. That's why it is crucial to avoid collections in the first place by staying on top of your bills and setting reminders or auto payments. And finally, let's tackle myth number 9. Myth no. 9. Credit is bad and should be avoided. Credit isn't inherently bad. It's a tool that can be used responsibly or irresponsibly. Like anything, it's all about how you handle it. Having a good credit score can save you thousands of dollars over time in interest and fees. It can open doors to homeownership, business financing, and emergency funds. Don't let fear of debt prevent you from accessing these benefits. The key is to respect credit. Understand how it works, use it wisely, and you'll see the benefits over time. In conclusion, your credit score doesn't have to be a mystery. By letting go of these common myths and understanding how credit works, you can take full control of your financial future. Check your score regularly. Use credit cards responsibly. Don't close old accounts without a good reason. Understand what affects your score and what doesn't. Most importantly, focus on consistency. Credit isn't built overnight. It's built through small, smart decisions over time. Stay informed, stay proactive, and watch your credit grow. If you found this video helpful, hit that thumbs up button. Subscribe to our channel for more financial insights. And remember, knowledge is power. The more you understand about credit, the better you'll be able to navigate it to your advantage. Thanks for watching.